Do you remember the story of Jack and the Beanstalk? Jack traded his cow for some magic beans. He planted the beans. They grew into this incredible beanstalk. He climbed up the beanstalk where he met a giant. Well, little known accounting fact, the giant had inventory, which Jack stole. Naughty Jack. But the way that that giant kept track of his inventory was by using an inventory method called FIFO. Remember, I don't charge extra for the accounting humor. Welcome to Accounting How To. I'm your host, Carolyn Grimm, and that's my jolly green sidekick, Terrence, and we're here to put the fun in accounting fundamentals. So we are in the midst of our inventory series, where we're going to go through the different types of inventory methods, FIFO, LIFO, and average cost, AVCO, step by step, so that it's going to be like I'm sitting down next to you while you do your accounting homework. Now, if you're a business owner, this is probably not a great video for you because it's going to make inventory way more confusing than it needs to be. But for my accounting students, this is exactly where you need to be. So let's dig in step by step into a FIFO example. Now, FIFO stands for first in, first out. And what we're going to do is we're going to base our inventory cost on first in, first out. So the first items that you buy, the oldest stuff, is what you're going to sell first as far as your cost goes. Now, part of the thing that happens with accounting textbooks is they kind of try to throw you into the middle of things without really fully explaining at the same time what's going on with the accounting system. So you get into this endless loop of, I don't get it. Wait a minute, I put the thing in the wrong place and now it doesn't come out right. What's going on here? So what I want to do is take a slightly different approach, a vastly different approach from what our accounting textbooks like to do. And I want to walk you through step by step exactly what's going on so that by the time we're done with this video, as well as our LIFO video and our AVCO video, our average cost, what I want you to be able to do is to understand what's going on. And when you understand what's going on, you'll be able to apply it in a way that we need to do it for accounting class. Now, the good news is, as we go through this, remember, this is the good news. You'll never do this in real life. So what we're doing here is we're trying to prove a concept in a way that we would have done it when the Pilgrims landed way back in the day, when I was young. So for the purposes of our accounting classes, this is to get you through. And I'm going to do it in such a way that you're going to have a better understanding of accounting when we get to the other side of this. Are you ready? Let's jump into the spreadsheet. All right, so here we are within the spreadsheet. Ooh, isn't this fun? So what I've got here is I have an example of exactly the types of exercises that you would see within your textbook. They're going to say something like, here are the facts. This is the stuff we know. We bought some stuff. We sold some stuff. And we're going to use the three different inventory methods to figure out our cost. Now, what does that mean? Here's what we're trying to get to. When we have a sales transaction involving inventory, we have two pieces to that when we're using perpetual inventory method. And I'll link the periodic versus perpetual inventory video in the description so you can see the differences between the two. But with perpetual inventory, we are going to be doing two parts to every sales transaction. There is the part where you're selling it to your customer. So here's an example here in our journal entry. We are going to debit accounts receivable. They're going to pay for it later. And we're going to credit sales. So that records our revenue and it records the amount that our customer owes us. But we have a second part to this transaction. We are recording our expense and taking this item out of inventory. So we have sold this little stuffy to our customer, okay? So it's no longer in our inventory, but our books say that it is. So now what we're going to do is we're going to take it out of our inventory, just like that. So we do that by applying a cost, our cost of merchandise sold, and by removing that cost from what's in our inventory. So what FIFO, LIFO, and average cost are doing are determining what that cost is that we're going to be taking out of our inventory. So let's walk through this like you're doing your homework, and you will see exactly these kinds of problems in your homework. Like I literally pulled this out of an accounting textbook. So here we go. We've got a date, we've got a transaction, we've got the number of units, we've got the cost of those units when we know it, and we have the total inventory amount. So on June 1st, we had 120 units left from the previous month. The cost was $26, and the amount of inventory is 120 times 26 units for $3,120. So that's the first thing that we know. And then we have a number of transactions that happen. So we've got a sale on June 10th, we've got another purchase on June 15th, a couple more sales, and then another purchase. So what your textbook will ask you for is, what's the cost of merchandise sold? Well, in order to get, you've got to jump through some fiery hoops. So we're looking at FIFO in this case, and we will do the same transactions for LIFO and for average cost so that you can really get a handle on this information that we see over and over again. First thing we need is we need a format to house our inventory transactions here. We've got three things going on. We need to have a column for purchases, we need a column for cost of merchandise sold, and we need a column to keep track of our inventory. And again, this is only for accounting class. This is not what you're going to do in real life. It's so much easier in real life. Real life is easier than textbook life. Thank you. So glad. So June 1st, first thing we're going to do is we're going to enter the amount of inventory that we have. So we have 120 units left from last month. The unit cost that was assigned is $26, and that gives us a total inventory of $3,120. Jump over here to this inventory T account. So here's our beginning inventory of $3,120. So we want to enter that in our T account, and I'm going to encourage you to use a T account as you go through these exercises because it really makes things easier. And of course, I'll link the T account video in the description in case you haven't been through that yet. So what's the first thing that happens? We have a sale on June 10th. We're going to sell 90 units. Let's come over to our cost of merchandise sold column. So we are selling 90 units. Well, what is the cost of those 90 units? Well, at this point, the only units we have are what's left in inventory from last month. We have 120 units, and the cost assigned to that is $26. So we are going to sell 90 units at $26 for a total cost $2,340. So what does that leave us in inventory? Well, we're going to take 120 units minus 90 units gives us 30 units at $26. So the value of our inventory right now on our books is $780. So that's what your textbook is looking for you to do. Well, I want you to actually understand what you're doing because that gives you accounting power. So let's go over to the other side of the accounting world and look at that. So here is a journal entry, and this is what we're going to do for each one of our transactions so that you understand what the rest of the picture is. So here's our journal entry for this transaction on 6/10. So we're going to assume that the units that we're selling are $50 per unit. This is what we're selling it to the customer for. So we sold how many units? We sold 90 units. 90 units times $50 per unit is $4,500. That's what we are charging to the customer. That's what our invoice says. But we need to also do the second part of that transaction where we're taking this item out of our inventory because it's no longer there. We sold it. It's gone bye-bye. It's flown out of the building. So how are we going to figure that cost? We're going to come back here to our little computation that we did in our wacky little spreadsheet for inventory. and we're going to use that amount right there. So we sold 90 units, the applied cost was $26, and we're now going to do a journal entry, second part of this journal entry that we need to do for a sales transaction under perpetual inventory. And we're going to debit our expense, our cost of merchandise sold, and we're going to credit our asset to reduce it for $2,340. So now we have recorded the cost of those items that we sold, keeping with the matching principle, right? And we're recording that we've taken this out of inventory. So let's jump into that T account. So we entered our beginning inventory balance of $3,120. Now we would post all 4 pieces of this journal entry to our accounts, but I want to focus for the purposes of this exercise on just the inventory account and what's going on in there. So we said we were going to credit our inventory to reduce it. So in our T account, we're going to enter this credit of $2,340. We'll subtract that from our beginning balance. So what we have left in that account is $780. And that ties out to what happened here in our little inventory spreadsheet. Okay? So then on June 15th, we purchase more inventory. When we purchase inventory, we're going to be debiting our inventory account to show that we now have more inventory, and we're going to be crediting either accounts payable or cash. So let's take a look at the journal entry for that piece of it. So here we go. We are debiting our inventory account for $3,920, and we are crediting, in this case, I picked accounts payable. If we were paying cash, it would be cash. And I put a notice here that we have purchased 140 units at $28. So as far as this journal entry piece of it, here's what we're going to do. We're going to post this to our inventory account as a debit, which is going to increase our balance to $4,700. But let's jump back to our inventory spreadsheet, because here's where we start to get the funky stuff. And funky is so what we need to do under FIFO is we need to keep track of the order in which our merchandise came into our inventory. So we're going to go step by step and list out every single chunk of inventory that came in. So let's look at what we've got here. We previously, before we purchased this, we had 30 units at $26 for $780 in our inventory. And that ties out to this right here, ties out to this right here. And so we have that, think of that as like your beginning inventory before this new transaction. So we bring that down in our spreadsheet. We're just dropping this down and saying, okay, now we have 30 at 26. And we're adding on 140 at 28. So the price of this item has gone up on the purchasing side of it. So now we've got 30 at 26 and we've got 140 at 28. Now to do these types of exercises, you're going to find that the most important thing is staying organized. You've got to bring things down in exactly the same way each time, because that's going to determine which units we sell next. And we're going to sell some units. So on June 20th, we're going to sell 110 units. And we've got to determine what the cost of those units is that we're assigning. First in, first out means that we're going to sell our oldest units first. Okay, so what are our oldest units in inventory? We have 30 at $26. So here, under our cost of merchandise sold, we're going to sell 20 at $26 for $780. That is going to leave us with 0 units at $26. We've now sold those. Those are off the books. And we're going to sell 80 of the 140 units that we bought at $28. So we're listing it out here in an organized way. We sold 30 at 26, we sold 80 at 28. Those two numbers added together, the 780 and the 2240, is going to give us our cost of merchandise sold, for this transaction. On the inventory side, now we know that we've got 0 at 26 left. Those are all gone. And all that's left in inventory is 60 at $28. It's the newer merchandise. So we sold the older merchandise. We have just the newer merchandise left. Let's look at what that looks like in our journal entry. So again, we're assuming that we're selling this for $50 to our customer, and we sold 110 of those. So accounts receivable $5,500 and our sales credit of $5,500. That records our revenue and it records what our customer owes us. But we need that second piece of it because this is perpetual inventory. So what we're going to use for a cost here is our $780 plus our $2,240, giving us $3,020. So we are recording our expense for those items that we just sold, and we're taking that out of our inventory. So if we look at our T account, we started with our beginning balance, we had a reduction in inventory when we sold, we have an increase in inventory when we purchase, and now we have a decrease in our inventory when we sold, giving us a new balance of $1,680 in our inventory account, which ties out to what we have over here in our funky little spreadsheet for our inventory computation. So what happens next? Because there's always something in accounting. That's why it's so interesting. So on June 24th, we sold 40 items. So what we need to do is we need to determine what the cost of those items was. So 40 items, the only items that we have in inventory are at $28 a piece. So we're going to assign a cost of $28. We've got 40 times 28 gives us $11.20 for our cost of merchandise sold, and it leaves us with 60 minus 40, or 20 units in inventory at $28 for $560. So over on the journal entry side, again, we're assuming a $50 price tag for our customer, and we are selling 40 of those units to the customer for $2,000. We're recording our accounts receivable, and we're recording our revenue, our sales, at $2,000. And then we are applying a cost to that to match up with our revenue. So we've got cost of merchandise sold for $11.20, which we're bringing over from our inventory sheet, and we are taking $11.20 out of our inventory. So when we post that to our T account, we are now seeing that credit of $11.20. It gives us a new balance of $560, which ties out to our spreadsheet. On June 30th, we buy 160 items at $30. The price has gone up again. And the total of that bill is $4,800. So what do we do to record that? We're going to come over here and we're going to record a debit to our inventory account to increase it by $4,800. And we're going to credit accounts payable for $4,800. When we post that increase to our inventory account, we now end up with an inventory balance of $5,360. Meanwhile, back at the spreadsheet, let's look at what we ended up with. So we still have 20 units at $28 that we had not yet sold that equaled out to $560. Now we're adding on 160 units at $30 for $4,800, which gives us an ending inventory of these two amounts added together of $5,360, which we proved out over here on the journal entry side. Our T account says our balance is $5,360. So the important thing is keep it organized and understand what's going on the other side of it. And you will have the spreadsheet in the description that you can download it, and you can use this for your homework if it helps you to plug things in this format and understand what's going on. So in our next video, we are going to tackle the same problem, but we're going to do it using LIFO. So I will see you on the other side. Till next time, stay balanced, my friends.